major banks gearing up to report earnings next week. Here to lay out a few stock picks in the sector, Ellen Hazen, Senior VP and Portfolio Manager at FL Putnam Investment Management Company. We teased one of your top picks before the break. Why don't we start with that mystery chart? It was Bank of America. Ellen, let me just start with your overall theme, and that is you want to build a barbell in your portfolio. So you want some value, and you'd like to avoid some of the secular challenges that other value stocks are subject to, and you think that the banks are a way to do that. Could you explain that?
Thanks, Joe. That's exactly right. Clearly, the growth stocks have outperformed value stocks for the last decade, with a few fits and starts in between. But as we start a new economic cycle, when that begins to be clear, we think value stocks will start to outperform. And at that point, you really want to own classic value stocks like banks. Banks are classic value stocks, and right now they're pretty inexpensive. The bank index is down over 30% this year. And yet the bank stocks as value stocks do not face some of the secular challenges that some other areas of the value index face. So between the valuations being very attractive, the prospect of an accelerating economy, and accelerating earnings into next year, we think the banks look pretty interesting as part of a balanced portfolio against the growth stocks that we also own.
Interesting. Okay, so Bank of America, we highlighted the chart. Why Bank of America? And then we'll get to your other two picks, too, as people are waiting for those. But why Bank of America?
Sure. The biggest reason to own Bank of America is the acceleration toward digital banking. Bank of America is a pretty inexpensive stock at 1.2 times book value. But the key here is that COVID and the stay-at-home economy that has prompted has really accelerated the migration to digital banking. And Bank of America had invested a lot of money in consumer digital banking for many years prior to this year. So they were very well positioned as that migration has taken place. On top of that, you have very tight cost control at Bank of America. And in general, we prefer the money center banks, which is Bank of America, JP Morgan, over the regional banks for a number of different reasons, which I can get into if you'd like.
Let's do that while we're talking about another one of your picks. JP Morgan, you like even more than Bank of America.
I do like JP Morgan even more. It's a little bit more expensive, but it has a higher return on tangible equity and a little bit of a faster growth rate. But let me talk about why both of those are more attractive than some of the other bank choices out there. The entire banking industry right now faces both headwinds and tailwinds. And the headwinds, I think, are well known: a flat-ish yield curve, as well as very low short-term rates. But the tailwinds are stronger performance in investment banking, in sales and trading, in asset management. And the money center banks are much more exposed to those trends than any of the regional banks. And then in addition to that, some of the companies and areas that have done poorly with this slowing economy have been, number one, commercial real estate in general, which the regional banks have more exposure to. So again, that's a reason to favor JP Morgan and Bank of America over the regional banks. And number two, lending to small and medium-sized businesses, which unfortunately have suffered more than large companies. So as we look at JP Morgan, gold standard bank, very strong balance sheet, building capital at 60 basis points a quarter because they've stopped the buyback. And so their capital position is just getting stronger. And then the cherry on top is that they have taken enough loan loss reserves that it looks as though they won't need to take any additional ones in the third quarter. So we could see accelerating earnings as the credit losses continue to be soft for JP Morgan in particular.
Great. Shepard Smith here. Thanks for watching CNBC on YouTube.